Hello, my name is Daniel. I've been trading this guardrail strategy that I've coined and created for about 2 years now. And I've fine-tuned it a little here and there, but the general principle of it has remained the same. And I've been very happy with the results in the past couple of years. And it's also, like I said, got tons of data to back it up as well. And it's not exactly, I'm not reinventing the wheel. I haven't created totally anything on my own, and I'm just kind of standing off the backs and the shoulders of other people that have done this before me. So getting right into it, this is the paper that I've created. It's really a draft. I don't have it finalized at all right now. I'm still working on getting more sourcing and just making it more polished and professional. But if you're interested in the full paper, just shoot me an email or leave a comment, and I'll hit you up and give you the paper. But this is the paper explaining exactly how the system works and why I chose to do what it does. So as you can see in this first paragraph, the guardrail model is a rules-based investment framework designed to manage downside risk while maintaining long-term equity growth. Built around simple quantitative principles, the strategy allocates sometimes dynamically between treasury bills or bonds, really just treasury bills, based on your needs, risk tolerance, and market trend conditions. And what that means is essentially there's 5 models, and 3 of the 5 models are 1x no leverage, just risk on, risk off allocations, and then 2 of them include leverage. And depending on your time frame, if you're going to need the money 5 years from now, or if you're going to need the money 30 years from now, you would definitely want to take different levels of risk there. So I'm guessing if you're watching this video, you already know what some or all of these terms mean. But in case you don't, you might see these throughout the paper, or I might mention them throughout the video. Compound annual growth rate is CAGR, and that's just if you were to average out the return over 10 years, what would the return be per year? Volatility is the standard deviation of returns, so you can just simply Google or ChatGPT or whatever you want the formula for standard deviation of returns. And that essentially just measures how much something moves up or down in a given time period and how volatile it is. The max drawdown is simply from the very top to the very bottom, what was the worst decline that it's ever seen. The Sharpe ratio is essentially the compound annual growth rate basically divided by volatility, and it's saying how much growth you get per unit of volatility. And then Sortino is essentially the same thing as Sharpe. It's just downside volatility instead of just total volatility. And then Ulster Index is how deep and long drawdowns have been. So a lot of people use max drawdown as a general risk assessment of a strategy or of an index or whatever. I personally don't really like that because you're measuring risk based off of one event that's ever happened rather than volatility. Obviously, volatility has its flaws as well. Warren Buffett famously and Charlie Munger hated volatility, and they never used standard deviation to measure risk. But in the academic community, it's generally regarded as a pretty good measure of risk. So the guardrail strategy is really based off the 200-day moving average, or you could call it the 10-month if you really wanted to. The 200-day moving average is simply the most recent 200 days of trading and their closing price averaged out. And that is this middle line here that you see in this picture. The 200-day moving average strategy is not at all new. It's been around for decades. Real quick before we get into the 200-day moving average and why it has merit, these are some of the returns of the pure trend versus regular allocations. So you can see that since from 1975 to 2026, the 1x just going full cash risk off and 100% long risk on has yielded better results than pretty much everything except for 100% stocks. 100% stocks is the only thing that's beaten it in terms of growth rate, but it's been able to do this for much less volatility than regular just holding stocks. It's about a third less volatility or even half the volatility sometimes. It's had a higher Sharpe than anything besides a 40-60 portfolio, which again has a much lower growth rate. But those are just some of the results. Again, you can pause the video to take a look at those if you want. One of the biggest problems with creating a model a tactical model is the problem of overfitting and looking at something and say, hey, this worked in the past 20 years or this worked in the past 50 years and thinking that it's going to work in the future. And you can, for example, take the NASDAQ 100 or the S&P 500 and overlay tons of different rules onto the stock market, and you'll find a strategy that has almost no downside and only upside. And then when you actually start implementing that strategy, it falls apart quickly because you just overfit it. And you can say, here's 5,000 trades over the last 100 years that you could have executed, and if you executed them in this order, then you would have had incredible gains and no downside. Well, it's because you're building a model that's a hindsight bias, and you know exactly what happened, and you can find rules that worked specifically well for that index. So in order to backtest and not have that happen, you need to not only separate your backtest into different eras. So I do it by decade. I just look at the 2020s, 2010s, 2000s, all the way back. I like to go back to the 1970s because that's when the actual index, S&P 500, in its modern form, more or less, was created. And before that, stocks were less liquid, a lot less people owned stocks, and just in general, the market data validity before the 70s and 60s is kind of debated. So the way I like to backtest is look at all these different decades and also cross reference your results and your rules across different indices. So don't just do the S&P 500. If you want to backtest something, don't just do it on only US large cap stocks or only NASDAQ 100. Do it on a lot of different indices. And if your rules work on everything ever, then all the more credit to you. And so what I did is I took these simple rules of just the 200-day moving average and I applied it to 30 different indices. I applied it to like technology stocks only, to bank stocks only, to international stocks only, to Asian stocks, to emerging markets, to every indice I could think of. And I back tested it to the 1970s or as far back as they went. So for example, the NASDAQ 100, it hasn't been around since the 1970s. So I back tested it as far back as I possibly could. And what I found was that this strategy on US large caps, the S&P 500, it returned 11.17 in this time period, and the average returned 10.5%. So it looks better on the S&P 500 than it does on the average index. However, max drawdown and the Sharpe ratio both were improved, as well as volatility for almost every single index I tested. So in every time frame and in every index I tested, it improves the volatility, it improves the max drawdown, and it improved the Sharpe ratio about 80% of the time. If you don't know this already, here it is. And you can see that the biggest difference between above and below the moving average is the 200-day moving average. And you could say, well, why not just use the 100 or the 20-day because it's so much closer to the actual price? And that's because of whipsaw damage. And if you use a 50-day moving average instead of a 200-day moving average, you're going to get so many more trades than using a longer term moving average. And every time you trade and have a false positive, that eats your portfolio slowly down and it grinds it down. And you want to have as little false signals as possible. And that phenomenon is visualized right here in this chart that I created. I took just on S&P 500, how many trades per year since the 1970s does each SMA length have? So you can see that the 100-day, and it goes even higher if you do a 50-day or a 20-day, but if you do a 100-day moving average, you're going to have over 11 trades per year. And if you go down to a 200-day, it goes down to below 6 trades per year. So you get this benefit of volatility prediction under the 200-day and under any moving average. It doesn't have to be the 200-day. It could be the 190. It could be the 220. It could be the 120-day. But just pick a moving average. Under that moving average, you're going to probably get higher volatility. And when you're above that moving average, you'll get lower volatility. But the longer your moving average, the less trades you'll have per year, which is a really, really good thing. In theory, you'd want as little trades per year as possible, not only due to trading costs, taxes, friction, but also because of simply the whipsaw damage of if it's a false positive, it's a false signal, you just lost money on that trade. So this chart 6 here, this visualizes exactly why trend is so hard to stick with for a lot of people. And trend is an extremely amazing strategy, but it's not very popular. And I personally believe the reason for that is because it just looks so different, and it performs so different than the actual stock market. And you could do trend following on bonds or on stocks or whatever, and the results are going to be pretty different than the actual stock market. If you have a simple long only where you're in the stock market when it's risk on, and then you're in cash risk off. If you do that, you can see on this chart, if you allocate 100% to trend, meaning that, like I said, you're 100% in stocks risk on and then 100% in cash risk off, your portfolio is only going to be about 2/3 correlated with the stock market, which is quite low. For example, if you do international stocks compared to US stocks, that's a much higher correlation than 2/3. And 2/3 correlation might sound pretty good to you, like it's usually going in the same direction, but that leads to periods of time like the 2010s and the 2020s where trend looks very different and underperforms the stock market. You'll also have periods where the stock market collapses and your trend is actually gaining because it's been risk off. You can just see it in this chart. The more you allocate to trend, the more disjointed your portfolio will be from the market. So the thing that I found was very interesting with this is that you can allocate just a 50% allocation to trend and you're still almost 95% correlated with the stock market. So if you, instead of doing 100% trend and you drop all the way down to 2/3 correlation, you can just do a 50% allocation to trend, and you're getting a lot of the benefit from trend of that volatility dampening and the left tail being cut off, while still maintaining a high correlation to the market. And like I said, the hardest part about trend is sticking with it when it has whipsaws and it's underperforming the market. And I'll give you an example. If you did full trend following on the S&P 500 with just a 200-day moving average in 2022 and 2023, you didn't bottom out until March of 2023, whereas the stock market bottomed in October of 2022. So you're sitting there and the market's going up and you don't bottom for another almost 6 months. That's extremely difficult to stick with. That's the reasoning behind you don't want to have a 67% correlation with stocks. You want a higher correlation in general. So as I said, if you do a 50% allocation to trend, you can get almost a 95% of the correlation of stocks. So there's another reason that you probably don't want to do 100% allocation to trend and you want to dwindle it down closer to 50%. And that's because of diversification math. So as you might know, tilting more towards a stock allocation or a bond allocation will lead you to diminishing returns to a certain point. So if you want to get the volatility reduction benefit that bonds offer, because bonds are far less volatile than stocks, and you want to get that benefit in your portfolio, the more you allocate to bonds, past 50%, 60% bonds, you're getting a diminishing return effect. And that's visualized in this chart. So if you go up to a 70% allocation in bonds, you're already getting almost 90% of the volatility reduction benefit that bonds offer compared to stocks. And then if you go up to 100% allocation to bonds, you're only getting about another 10% in volatility reduction benefit. So if you do a 50-50 allocation to bonds and stocks, you can see right here in the middle, you're getting almost 70%, like 65 or 70% of the volatility reduction benefit that bonds offer, while only doing a 50% allocation to bonds. So you're maintaining that long-term growth from the stocks, but you're getting most of the benefit, like 2/3 of the benefit that bonds offer from the volatility reduction standpoint. And then you take the same principle to allocation to trend. So 0% allocation to trend on this chart means just buy and hold. If you just buy and hold the S&P 500, and then 100% allocation to trend means that you're 100% 1x in stocks when risk on, and then 100% in cash risk off. Again, that was 67% correlated with the market. So you can see that when you do a 50% allocation to trend, you're getting about 70% of the benefit that trend offers in terms of the volatility reduction benefit. So as I said, trend following has almost always lower volatility than buy and hold stocks. And that's one of the main benefits of trend, is that you have lower volatility, lower downside. Now you can, again, with this chart, as you can see, you can get 70% of that benefit by just doing a 50% allocation to trend. And you can see that going from, for example, 80% trend up to 100% trend, you only are going from like 90 something percent to 100% of the benefit. So it has diminishing returns. And the point at which it starts to diminish is about 50%. This is another way to visualize that. The more you allocate to trend, the less benefit you're getting per increase. So you can see that first 50%, you're going all the way from over 17% volatility in stocks all the way down to about 13, just over 13% volatility. And then going from 50% allocation to trend to 100% allocation, you're only going from 13 point something down to 11 point something. So it's still definitely less volatile, but you're getting most of the benefit just from a 50% allocation. So this next part is about tolerance bands. And just to visualize that, I'm going to go onto TradingView here to show you guys what I mean by this. So tolerance bands on a simple moving average are these bands above and below. So the moving average is the line in the middle, the gray line, and the price is all the little bars. And then the top band is the green line and the bottom band is the red line. So when you have a daily close below the red line, that means you're risk off. When you have a daily close above the green line, that means you're risk on. Now for typical, if you don't use tolerance bands at all, you're just going purely based off that gray line, the moving average. But with tolerance bands, maybe they're 1% above or below, or 2%, 3%, whatever. Everyone uses different ones. But this is a way to mitigate those false signals. And if you're just going based off of daily averages and daily closes, you're going to have about 70 to 80% of the time you're going to be wrong. So it's not necessarily worse in terms of long-term growth, because when you're wrong very small and you lose a little bit. But being wrong most of the time is difficult, and you're going to have switch times where you're switching every single day or you're switching multiple times in a week, and that's just very difficult to invest in. But when you use tolerance bands, that mitigates a lot of that pain. And so it's one of the most common strategies to mitigate whipsaws and increase the win rate. This chart here shows that using tolerance bands does not increase or decrease your long-term expected growth rate. I applied tolerance bands to the S&P 500, total US stock market, total world stock market, the NASDAQ 100, the total world ex-US stock market, and then emerging markets as far back as I could go. And you can see on the white line is the average, that there's really no impact of tolerance bands on the long-term growth. The x-axis is what band size I used, and then the y-axis is the growth rate. So you can see that white line is basically flat out to past 3%, and then it starts to go down. I did test past 5%, and it continues to go down. So it seems that tolerance bands have no effect on long-term growth up until about 3 or 4%. And the reasoning for that is because, back to this chart, if you have a small band size, you're filtering out less trades than a bigger band size. However, each loss is going to be a lot smaller. So if you increase the band size to, say, 4%, you're going to be filtering out way more trades, and you're going to trade very not so often. So you can see here in the 2022 bear market, it only had one risk off period, and then it got back in and it didn't look back. It didn't get whipsawed here. It didn't get whipsawed here. It just went down and that crashed, and then it went right back up. So you have hardly any false signals with that 4% band. However, when you are wrong, you're wrong in a very big way. And so, for example, with COVID, with the crash of the pandemic, you ended up selling down here, and then you didn't buy back until way up here. So you missed out on a 16% rally in stocks. Whereas if you didn't use any bands at all, you ended up getting whipsawed a little bit here, and then you got in way down here instead of up here. So again, to summarize, the bigger the bands you use, the more whipsaws or false signals you're going to filter out, but you're also increasing the size of each time you're wrong. And that's why this chart here shows that it ends up being a moot point and it doesn't really matter. Now, however, with that said, you still do want to filter out some trades. I prefer my strategy. I think you could go anywhere from 0 to 3% bands, but I like to use 1% because it's still very close to the moving average. And I also found that the bigger the bands you use, the less of the volatility decrease benefit you're getting. So if you use 5% bands or 4 or 3% bands, you're getting less of that volatility decrease than if you trade based off just purely the moving average. Now, like I said, use 1% on my strategy because it filters out over 60% of the trades, and 60% of the false signals are gone while still being very close to the moving average. And the reason I like to filter out 60% at least of the trades and whipsaws is because of friction in trading. And even if you have zero brokerage fees and you're trading in a non-taxable IRA account and you have no taxes to worry about, you still have bid-ask spreads to worry about. And even if you're trading on SPY or VOO or SSO and SGOV, like just very liquid ETFs, you are still paying every round trip about 2 basis points, anywhere from 1 to 4 basis points on a highly liquid ETF. So if you don't use any bands at all, you're going to have about 6 to 8 trades per year on your strategy. And if each switch is going to cost you 1 to 5 basis points, that adds up pretty quickly. And you're going to be paying anywhere from 10 to 30 basis points just in bid-ask spreads. That's not horrible, but when you add that on top of the expense ratios, add that on top of maybe taxes, and it's just makes it not worth it. So to demonstrate that point, I've included this chart here, and this shows the theoretical annual bid-ask spread cost. And I use SPYM because it's very liquid and it has a low expense ratio. I use SGOV for cash positions, VT, SSO, UPRO. And on average, these are the bid-ask spreads when they're liquid during the market hours. So that means that every time you buy and sell SPYM, you're losing 1.6 basis points. And every time you buy and sell UPRO, you're losing 6 basis points, which adds up very quickly if you're trading 6, 7, 8 times a year. And you can see that on average, you're going to be paying almost 17 basis points per year in bid-ask spreads. But when you go down to 1%, it's less than 8. It's about 7 basis points a year of bid-ask spreads, which is, to me, that's totally fine. Going from 1 to 2 only takes you from 7 basis points, or about 6 to 7 basis points, down to 4 basis points. So going from 1% tolerance bands to 2% only gains you a few basis points in annual trading costs. So I really don't care about that. So again, that's my summary of why I use 1% tolerance bands. So there's a lot of videos out there explaining why you should or should not use leverage, why you should or should not use leveraged ETFs as well. And you can find other videos explaining why it is or is not a good idea to invest in leverage in the long term. Especially leveraged ETFs. The only reason mathematically that they're actually not so good at the end of the day is because of the expense ratio on leveraged ETFs. However, running your own option strategy where you're maintaining 2 or 3x daily leverage or using margin to get leverage is way more expensive, I think, than just using a leveraged ETF that you pay 80 to 100 basis points in expense ratios. But in case you aren't aware of why people are skeptical about holding leveraged ETFs in the long term, this chart shows you why. This is a real week. And again, I didn't create this I didn't find this, but this is just the way the math works out. And this is taken from a different SSRN paper. This is a real week in 2011, and you can see the returns, or it's 6 days of trading. You can see the returns during this week of the S&P. It went down 6.6%, and then it went down the next day. It went up 4.7%, and then it went down 4%, and then it went up 4%, and then it went up 0.5%, and then up 2.2%. And after all that, the S&P was up 0.5%. But after all that trading, the 3X you can see is down 2%. And just think about it for 1 second. Why would that be? It's simply because when the S&P goes down a certain percent, the 3X goes down 3 times that much in the same day. And then you not only require that same amount to get back to even, you need even more to get back to even. And that's just how compounding math works. However, this is very bad for sure if markets are going sideways and they are volatile. However, when markets are trending up or trending down, it's really not a problem for these leverage ETFs. In fact, when markets are trending higher, this what they call leverage decay or volatility decay, this actually helps you when markets are trending higher. And that's because every single day that the market goes up, you are re-leveraging up to that 3%. So in a typical margin account, if you were to double your amount of money that you have invested into the stock market and you take on 100% leverage, meaning you're 2x invested, and then the market goes up 50%, then now your leverage factor is lower than 2x because your position has appreciated so much, and now you have a lower than 2x target margin, target leverage. So these leverage ETFs are constantly buying as the market goes up and selling as the market goes down. So same thing in reverse. If you were to have a margin account and you get in at the top and you leverage your account at the very top of the market, and then it goes down for 6 months, the leverage ETF will actually be down less than you are in your regular margin account. And that's just the way simple daily compounding reset leverage works. So this goes into what I was saying earlier about volatility in the 200-day moving average, that yes, it's bad to hold leverage in a sideways volatile or downtrending heavily volatile environment. However, the 200-day moving average, or any other moving average for that matter, is able to predict volatility somewhat well. And volatility roughly doubles when you're underneath a long-term moving average like the 200-day moving average. So to avoid this volatility, this kind of chart, we use the 200-day to get out and avoid that leveraged decay, as they call it. So these are the stats of the 3X leverage, which is the one I use in my IRA. This is the US Guardrail 3, and I've been using it since 2024. I don't think I've been using it since the beginning of 2024. I could go back and check, but I've been using it at some point in 2024. I started this. And so since 2024, it's up 81% almost, and that is an average of 30.24. I'm recording this on the 27th of March of 2026, and currently it's in a drawdown right now on the 27th of March. It's currently in about a just over 20% drawdown because the market has come down since. All in all, this strategy is not for everyone. I tried to cater it as well as possible for everyone so that it's easy to stick to for most people. Buy and hold is very difficult to stick with for a lot of people. Buy and hold when stuff hits the fan, 2020 and in 2022 and 2008, or the dot-com bubble burst, people get emotional when they see that their stocks are down 30, 40, 50% and tend to sell. So buy and hold overall is an amazing strategy. And I think it's probably the best to just own a diversified portfolio of stocks and bonds, but it's really hard to stick to for a lot of people. And so that's why I have this. It's 95% correlated with the market, but you still get about 70% of that trend following benefit of that volatility reduction. And I personally have loved it because I know that any given year, my results are essentially going to look like a leveraged portfolio in the stock market, but I'm getting a lot of that sharp improvement that trend offers and that volatility reduction that trend offers. Let me know if you have any questions. If you want to see further data on this, or if you have questions on how I came to some of these conclusions, yeah, just hit me up. I'll put my email in the description. And yeah, I hope this was an informative video. I simply just wanted to put out a video on what I've been doing for years now. So yeah, thank you for watching.